Hi, today we will understand about the topic bonds. So let's just dive into it. Let's first understand what does government bonds and corporate bonds mean. Government bonds are being issued by the government to fund infrastructure, development, etc. While corporate bonds are issued by public or private companies in order to fund their business expansion, operations, or debt restructuring. Speaking of safety, government bonds, often called GSECs, carry a sovereign guarantee, which is the highest level of safety you can get in India. However, corporate bonds vary in safety depending on how financially strong the issuing company is. Government bonds can give you moderate returns, usually between 6.5% to 7.5% annually. Corporate bonds give higher returns, sometimes 8 to 10%, but with a little more risk. Government bonds are ideal for those who are risk averse, plan for the long term, or want retirement stability. If you want higher returns and are okay with taking a bit more risk, corporate bonds might suit you. Examples for government bonds include GSECs, T-bills, and state development loans. Examples for corporate bonds include debentures, company bonds, etc. Government bonds are strongly supervised by RBI and SEBI, ensuring transparency and trust. Corporate bonds are also regulated, but the level of security can vary depending on the issuer. Moving ahead, we will focus on government bonds because as an investor, I prefer to talk about the instruments I have actually invested in rather than the ones I haven't. Now, let's understand about government securities or GSECs. A bond can be bought in three ways: at par, at a discount, or at a premium. At par or face value or true value means that you buy the bond at its original price, which is usually 100 rupees for almost all the government bonds issued. At a discount means you buy it for less than 100 rupees. For example, if the bond is trading at 95 rupees, you are getting it cheaper than its actual face value. At a premium means you buy it for more than 100 rupees, for example, paying 105 rupees for a bond whose face value is 100 rupees. Now, let's talk about a very important concept in bond investing: YTM, or yield to maturity. YTM simply tells you the actual return you will earn if you buy a bond today and hold it till the very end, until maturity. It includes everything: the interest payments you receive every year and any profit or loss you make when the bond matures. So, YTM is not just about interest, it shows the true total return from your bond investment. Now, let's look at the formula in a simple way. In the YTM formula, as you can see, C stands for coupon rate, or the interest you get every year. F is the face value of the bond, usually 100 rupees. P is the purchase price, the price you pay in the market today. N is the total number of years you will hold the bond until maturity. Using all these four values, YTM tells you how much return you are actually earning every year by holding the bond till maturity. We will take the government bond 702GS 2050. First, the face value, also called the true value of the bond, which is rupees 100. This is the amount you will receive back at the time of maturity, regardless of what you invest, whether you buy at discounted price or premium price. Next, the coupon rate is 7.02%, which means the bond pays rupees 7.02 every year as interest on every 100 rupees you invest. Usually, the interest is paid semi-annually, which is 3.51%. Here, the maturity year of the bond is 2050. Let's understand it more deeply with few examples. Let us consider two scenarios if we purchase the bond 702GS 2050 in 2025 at discounted price. First scenario would be if we purchase the bond at discounted price at rupees 95, and after holding for a year we sell it at rupees 101. Here the coupon rate is 7.02, Since we sell the bond after a year at rupees 101, so F will be 101 instead of 100. We would have considered F as 100 if we had hold the bond till maturity. Next, P will be 95 and N will be 1. So the YTM comes out to be around 13.28%. Let's look at the second scenario. If we purchase the bond at discounted price, which is rupees 95, and hold it till maturity. So the bond will be sold at rupees 100 on maturity. Here the coupon rate is 7.02, F is 100, P is 95 and N is 25. So the YTM comes out to be around 7.4%. As you can see, as we increase the number of years, the YTM gradually decreases as it averages out the returns over the next 25 years. Let us consider another two scenarios. If we had purchased the bond 702G2050 in 2025 at premium price. The first scenario would be we buy the bond at premium price, which is rupees 105, and after holding for a year we sell it at rupees 101. Coupon rate remains the same, which is 7.02. F is again 101. P here is 105 and N is 1. So the YTM turns out to be around 2.9% for a year. Second scenario is we buy the bond at premium price, which is rupees 105, and hold it till maturity. So coupon rate will be 7.02, F is 100, P will be 105 and N is 25. So YTM is 6.7%. So we can conclude that YTM for buying at 95 and selling it at 101 after a year will give 13.28% return. YTM for buying at 95 and selling it at 100 after 25 years will give 7.4% return. YTM for buying at 105 and selling it at 101 after a year will give 2.9% return. YTM for buying at 105 and selling it at 100 after 25 years will give 6.7% return. So, always calculate the YTM before investing in any government bond in order to get to know the actual return you will receive annually. I hope you have liked this video and I would like you to share and subscribe to this channel and wait for more updates.